Stop whatever you're doing. I mean it. Put down your phone, close the other tabs. If you're driving, pull over and listen. Because what I'm about to walk you through in the next 15 minutes could be the difference between you coming out of the next 90 days wealthier than you've ever been, or watching everything you've built in silver get ripped apart. This is not a price prediction video. I'm not here to tell you silver is going to hit some magic number by some magic date. What this is a preparation and survival guide. Because the data I'm looking at right now, the real data, not the headlines, not the talking heads, tells me something massive is building in the silver market over the next 30 to 90 days. And here's the uncomfortable truth. Some silver holders are going to absolutely thrive through what's coming. And others, people holding the exact same metal, are going to get destroyed. The difference won't be who had more silver. It'll be who was prepared and who made emotional decisions in the heat of the moment. So give me 15 minutes. That's all I'm asking. 15 minutes of your full attention could save you from a disaster or position you for the opportunity of a lifetime. Before we dive into the data, if you're not subscribed to this channel, now is the time. Hit that subscribe button and turn on notifications because COMEX data shifts fast and I break it down here in real time so you're never caught off guard. Also, drop a comment below and tell me how you're holding your silver right now. Are you in physical, ETFs, mining stocks, futures contracts? Let me know. Because understanding where you are helps me tailor the preparation advice in these videos to what actually matters to you. All right, let's get into it. Today is February 13th, 2026. Tomorrow is Valentine's Day. People are buying flowers, making dinner reservations, going about their lives like everything is normal. And on the surface, sure, it looks normal. But underneath, the data I'm pulling from COMEX, the US Mint, industrial consumption reports, options markets, and dealer networks is painting a picture that is anything but normal. Let me give you the snapshot. Silver is sitting at $78.53 an ounce on the COMEX spot price as of right now. Now that number by itself might not mean much to you, but let me put it in context. On January 29th, silver hit a peak of $121.64. Then it crashed, hard, fell all the way down into the mid-60s. And just yesterday, we saw a 3.85% rally that brought us back to where we are now. So what does that tell us? It tells us we're watching compression. Think of it like a coiled spring being pushed down tighter and tighter. The price action you're seeing right now is not resolution, it's tension building. And when a spring this tightly wound releases, the move is violent. The question is whether you'll be positioned correctly when it happens. Now let's talk about the data that's actually keeping me up at night, and this is the COMEX data breakdown. The registered inventory, that's the silver sitting in COMEX vaults that is actually available for delivery, currently stands at 28.4 million ounces. I need you to understand what that number means. On January 24th, just 3 weeks ago, that number was 124 million ounces. That means in 21 days, COMEX registered inventory dropped by 95.6 million ounces. That is a 77% decline in 3 weeks. I'll say that again. 77% of the deliverable silver in COMEX vaults is gone in less than a month. Now let's look at the other side. Open interest currently sits at 138,400 contracts. Each contract represents 5,000 ounces, which means there are 692 million ounces in paper claims right now floating above that vault. Do the math. That's a ratio of 24.4 paper ounces for every single physical ounce available. That ratio was 22 to 1 not long ago. It's getting worse, not better. And here's the number that really matters. It only takes about 4.1% of those contract holders to stand for delivery, to completely empty the vaults. Not 50%, not 20%, 4.1%. And what we saw in the recent delivery cycle is that real demands, real withdrawals actually happened. People took metal out. That's why the inventory cratered. Now here's the timeline. March 1st, the first notice day for the March COMEX contract is 12 days away. 12 days. If even a fraction of those contract holders decide they want real silver instead of paper promises, the math doesn't work. The silver simply isn't there. Drop a comment if you were even aware that COMEX inventory dropped 77%. I think a lot of people have no idea this happened. Let's move to the US Mint, because what's happening there confirms exactly what the COMEX data is showing. In January 2026, The mint sold 1.88 million silver eagles. Now on the surface, you might think that's decent. But remember, silver was at $122 during January. At that price, you'd expect demand to cool off a bit. But the low sales number wasn't because people didn't want eagles. It was because the mint couldn't make enough of them. They're dealing with blank shortages. The refineries that supply the raw planchets are overloaded and can't keep up. Moving into February, the situation hasn't improved. Rationing is still in effect. Dealer allocations remain unchanged, meaning dealers are only getting a set number of coins regardless of how much demand they're seeing. Premiums on eagles right now are running $8 to $11 over spot. That's 10 to 14% above the price of silver itself, compared to a normal premium of $3 to $4, and it gets worse at the dealer level. I'm hearing reports of dealers sitting on orders for 45,000 ounces that they simply cannot fill. The mint's lead time has ballooned to 11 weeks. In a normal market, that's 2 to 3 weeks. When the entity responsible for producing the most recognized silver coin on the planet can't keep up, that's not a demand blip. That's physical scarcity showing its face. Now let's talk about why this scarcity isn't going away, and this is the industrial demand picture. In 2025, industrial silver consumption hit a record 698 million ounces, up from 680.5 million the year prior. And the forecasts for 2026 are pointing to somewhere between 720 and 740 million ounces. Let me break down where that demand is coming from. Solar is the biggest driver. In 2025, solar panels consumed roughly 235 million ounces of silver. For 2026, with global solar capacity expected to rise 29% to 670 gigawatts of new installations, that number is heading toward 300 million ounces. Electric vehicles used about 74 million ounces in 2025. With EV sales projected to climb 26% this year, we're looking at around 93 million ounces. Artificial intelligence and data center buildouts consumed 22 million ounces last year. As the AI infrastructure arms race accelerates, that's forecasted to hit 28 to 30 million ounces. And then you have everything else: medical devices, electronics, military applications, water purification, 5G infrastructure. All of that adds up to roughly 320 million ounces. Total it up, and you get approximately 745 million ounces of industrial demand alone in 2026. Now here's why that matters. Global silver production in 2025 was about 1.03 billion ounces. Industrial demand at 745 million ounces consumes 72% of all silver mined on the planet. That leaves only 28% for investment, jewelry, silverware, and everything else. This is not a temporary spike. This is a permanent structural shift in how much silver the world needs, and production is not growing fast enough to keep up. If this data matters to you, smash that like button, share this video with someone who holds silver, and make sure you're subscribed because I'm going to keep covering this as it unfolds. Now, if the COMEX spot price was the real price of silver around the world, everything I just described would be concerning but manageable. But it's not the real price, not even close. Let me show you what silver actually costs in different parts of the world right now. In China, the government has denied export licenses for silver since January 1st. Silver on the Shanghai exchange is trading at $92.35. That's a 17.6% premium over the COMEX spot price. In India, silver is trading at approximately $235 an ounce. That's a 218% premium. Let that sink in. In the Middle East, premiums are running 40 to 60% above COMEX, compounded by ongoing petrodollar transition dynamics. So what's the real price of silver? In Shanghai, it's over $92. In India, it's over $235. In the Middle East, it's somewhere between $110 and $125. Here in the US, if you walk into a dealer right now, you're paying well above spot with those elevated premiums. The COMEX spot price of $78.53 is a fiction. It's a number on a screen that increasingly has nothing to do with what it actually costs to get real metal in your hands anywhere on Earth. So what actually lights the fuse? I see 4 key triggers, and any single one of them could set this off. The first is the March COMEX delivery cycle. There are roughly 72,000 contracts open for March. That represents 360 million ounces of potential delivery demand against 28.4 million ounces of registered inventory. If just 10% of those contracts stand for delivery, that's 36 million ounces of demand against 28.4 million available. The math breaks. The second trigger is industrial supply disclosures. Over the next few weeks, major manufacturers and tech companies are going to report earnings. When they start publicly disclosing supply chain issues with silver, and some of them will, that puts the shortage narrative in front of the mainstream financial media. The third trigger is sovereign fund accumulation. There are credible rumblings that a large sovereign wealth fund is preparing to make a significant allocation into physical silver. If a nation-state level buyer enters this market, the available supply evaporates overnight. The fourth trigger is dollar weakness. The U.S. debt situation, the deficit, persistent inflation, any of these could spark a meaningful reversal in the dollar. And when the dollar weakens, hard assets like silver catch a serious bid. Here's the key. Any one of these triggers, just one, could send silver from $78 to somewhere between $100 and $130 rapidly. And if that happens, premiums won't be $8 to $11. They'll be $20 to $40 or more. The time to prepare is before the trigger fires, not after. Tell me in the comments which of these four triggers you think hits first. All right, so now you understand the data. You see the setup. Let's talk about what you actually do about it. I have 6 preparation steps, and I want you to take these seriously. Step 1 is to audit your holdings. Sit down and list every single piece of silver exposure you have. Physical coins and bars, allocated storage, unallocated storage, SLV, PSLV, futures contracts, mining stocks, everything. Write it all down. Then rank each one by counterparty risk. Physical silver in your possession is the safest. It has 0 counterparty risk. Nobody can default on you, freeze your account, or fail to deliver. On the other end of the spectrum, futures contracts carry the most risk in a delivery crisis because they depend entirely on the system functioning normally. And the data is telling us the system is under historic stress. Step 2 is to secure your storage. If you have physical silver, it needs to be in a bolted down safe in a location that isn't obvious. Not the master bedroom closet, not the garage shelf. As prices rise, and especially if silver becomes a mainstream news story, operational security becomes critical. Think about who knows what you have and where you keep it. The fewer people who know, the better. Step 3 is to build dealer relationships now. Contact 3 to 5 reputable dealers this week. Don't wait until silver is at $120 and everyone is scrambling. Ask them about their current inventory, ask about their premiums, ask about their buying and selling processes, understand their policies on large transactions. When the market gets chaotic, having an established relationship with a dealer who knows you is worth its weight in, well, silver. Step 4 is to pre-decide your scenarios. This is the one most people skip, and it's the one that gets them wrecked. Sit down right now while you're calm and rational and write out your plan for each scenario. What do you do if silver goes from 78 to 130? What's your move if it crashes to 50? What if COMEX declares force majeure and halts trading? What if you wake up and silver is gapped up $40 overnight on a shortage headline? If you don't decide these things in advance, you will make emotional decisions in the moment, and emotional decisions in volatile markets are almost always the wrong ones. Step 5 is to size your positions appropriately. I don't care how bullish you are on silver, you need liquidity. Make sure you have 6 to 12 months of living expenses accessible in cash or near cash. Do not put yourself in a position where a short-term crash in silver forces you to sell at the worst possible time because you need to pay rent. Overconcentration kills portfolios, even when you're right about the direction. Step 6 is to understand your tax situation. Physical silver is classified as a collectible by the IRS, which means it's subject to a maximum long-term capital gains rate of 28%, not the lower 15 or 20% rate that applies to stocks. You need to know your cost basis on every piece you own. You need to know your holding period. You need to understand how losses work. Consult a tax professional who understands precious metals. Do this now, not in April when you're scrambling to figure out what you owe. Now I want to address something, because I know some of you watched that crash from 121 down to the mid-60s, and you're wondering what happened. Was the squeeze real? Let me be clear. The squeeze was absolutely real. Silver went from $29 in November 2024 to $121.64 in January 2026. That's a 320% gain. That happened. What also happened is that the banks counterattacked. They dumped massive amounts of paper contracts onto the market. Coordinated media coverage pushed fear. The price cratered to shake retail holders out of their positions. And for some people, it worked. They panicked and sold. But here's what the counterattack didn't fix. The shortage got worse, not better. Inventory didn't go back up, it fell further. The banks bought themselves time, but the vaults continued to drain. And now, with March 1st, 12 days away, that time is running out. I want to be transparent about where I stand personally. I'm holding all physical silver. I didn't sell at the peak, I didn't sell during the crash, and I'm not selling at $78. The reason is simple. Nothing about the fundamentals has changed. COMEX vaults are still depleting. Industrial demand is still surging. The supply deficit is still growing. China is still restricting exports. The US debt situation is still deteriorating. The thesis hasn't changed, so my position hasn't changed. Now, I didn't get here without learning some hard lessons. I've lived through crashes. I've seen what leverage does to people. I've watched paper silver promises evaporate. That's exactly why I hold physical, why I have secure storage, why I have dealer relationships, and why I have a decision framework already in place. I'm not guessing. I'm prepared. Let me bring it all together. Silver spot price, $78.53. COMEX registered inventory, 28.4 million ounces, down 77% in 3 weeks. Paper to physical ratio, 24.4 to 1. Days until March 1st notice, day 12. Projected 2026 industrial demand, 745 million ounces. Premiums running 3 times normal levels. Every single one of those data points is flashing. If you haven't subscribed yet, do it now. And turn on notifications because things are moving fast, and I'm going to keep breaking this down as new data comes in. Drop a comment telling me what your first preparation step is going to be and what you're holding. Share this video with anyone you know who owns silver because they need to see this data before March 1st. Remember the 6 steps. Audit your holdings, secure your storage, build dealer relationships, pre-decide your scenarios, size your positions, know your taxes, and above all else, hold physical. Real metal in your hands is real wealth. Everything else is a promise, and promises break under pressure. The spring is loaded. The countdown is on. 12 days. The question isn't whether something is going to happen. The data has already made that clear. The only question is, are you prepared